Welcome to the debt market update for August 2022. It was a surprising steady month the last month. The India 10-year bond, the sovereign bond moved down by around 7 basis points to close around 720. The money market rates moved up by 25 basis points following the tighter liquidity conditions prevalent. What helped the longer end of the curve, specifically the 5 and the 10-year GSEC and the bonds, was talks about a possible inclusion of India bonds in the global bond indices. This inclusion, which may possibly happen in the last quarter of this financial year, may bring in annually close to $40 billion both active and passive, paving the way for probably lower interest rates. Inflation continued to be low, 6.71. Crude and commodity prices continued to be stable, helping the bond markets. However, this was not the case in the US. The US 2 and the 10-year moved up by close to 45 and 55 basis points, and the US 2-year surprisingly is at a close to 2007 and 2005 high. The US Fed Governor Jerome Powell was categorical in his Jackson Hole symposium, the fact that he would do everything under his control to bring inflation down. In fact, making links to whatever Governor Volcker did in the 1975 to 1980 region. So hence the US 2 and the 10-year both reacted and moved up by close to 45 and 55 basis points. So what should an investor do in the Indian bond markets? We believe the fact that the RBI may be in the last leg of the rate increase cycle, and going forward we may see stable to a lower bond interest rates. We advise our investors for a longer tenor horizon. If the investment horizon is a slightly longer tenor, they can look for a short bonds and the short-term funds and a dynamic bond fund. For extreme short-end requirements, they can possibly park monies in the money market through ultra and low duration funds. Thank you for listening to us.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.